M&M Finance is a company in focus. The company has delivered a strong profit growth in the second quarter. The asset quality as well has improved, and it'll be interesting to note what sort of trends is the company witnessing, especially in the rural market where they have quite a bit of business going on. Ramesh Iyer, the MD and VC of M&M Finance, joins us now on the show. Mr. Iyer, thank you so much for giving us your time. Good numbers, strong profit growth. Provisions are down on a sequential basis. Let's focus in first on the provisioning bit. How do you see that pan out for the rest of the quarter, and the profitability as well for the rest of the fiscal?
So, we have said this in the past. We are very, very closely watching the development at the marketplace. No one has a real understanding of how will COVID pan out next 2 quarters, 3 quarters. So we would watch it very closely. What we definitely see on the market is the customer sentiments are positive. So therefore, the collections have held up well, and that's the reason you see NPAs coming down. But even in the third and the fourth quarter, normally it's a good rural quarters historically, because the harvest would come in, and this time the monsoons have been good. And therefore, we do expect the cash flows to be better. There are also, opening up of infra story, which will also improve the cash flow. So we think that we are in the path where we would see curtailed NPA even going forward for sure. And that should result both into the provisioning requirement being adequate already. Maybe we will try and look at separate segments, pockets, geography, and if required, we will make additional provision. But I think definitely things are looking good for us from the rural perspective.
You are a rural-focused player. We can say that a lot of your business comes in from the rural areas. Are you seeing a strong recovery in sentiments? Is that a positive? How will this increased demand translate into better disbursement? How far are you away, say, from the pre-COVID levels?
So, first 6 months, of course, was very, very different, much lower than the previous year. But if we were to just look at the festival season, while the numbers are yet not out, but when we talk to the OEMs and when we talk to the dealers, very clear indications of the demand continuing to be high. There are some products not available as well. The supply is weak, but nevertheless, the footfall at the dealership, the footfall at our branches have all increased. So clearly, we do see demand buoyancy. So if you were looking at, let's say, the festival demand of both Dussehra, Diwali together compared to last year, I would think we would be pretty much there. So the pre-COVID number that we are talking of in terms of festival, that number should be achieved, I guess, even in this festival. As far as going forward is concerned, again, I would speak more on the rural front. With the crop expected to be good, I would think the demand should continue. And the question is really going to be, are OEMs able to make supplies available for all products across? And if that was to be made available, I'm sure the numbers would return back.
Right. So asset quality has actually improved this quarter. You have mentioned that, you don't see much concern on NPA going ahead. However, analysts believe that there could be some spike in the near term. What would you say to that?
Definitely, we don't see a spike, that's for sure. But there are some segments like the school bus operations, whether it is the taxi aggregators. These people would definitely need little more time, right? Because if the schools have not opened and they are likely to only in the next academics, so the school bus operators, whether it's a small van or whatever, they would start to earn only later. So if the moratorium has ended September, these are the segments who may not be able to service the loans immediately. And possibly those are the ones which may come up for restructuring. But barring that, I think in every other segment, we would see improvement, at least from the rural market. And we don't therefore see any spike in NPA. Yes, sequentially, will there be a little increase? I would imagine the answer is yes, as I said, from this 2 or 3 segments. But as things pan out in the next 6 months' time, you would start seeing even the taxi aggregators coming back to some level of earnings. They may not come back to the original level with the airports opening up, with people movement increasing. So the taxi engagements would start to improve. And the school bus would take at least another 6 months plus. Bearing these two segments, I think we don't see NPA spike at all. And rural, normally October to March is a cash flow quarter.
Mr. Iyer, where do you see AUM growth, in FY21? Where is, demand or growth largely coming from, and what's your focus area for growth?
So clearly we see demand for small pickup vehicles, LCVs are doing well because they are all essential goods carrier, fruits, vegetables, traders. So this vehicle segment will definitely do well, and that's doing good for us. Vehicles like Boleros, pickups, those kind of products. We see passenger car segment, small car segment especially. We do see demand for that vehicle, and as we are one of the significant player financing small cars for Maruti and others, we would see benefit of that. Pre-owned vehicle seems to be another good segment, but of course currently supply is a little weak because not too many NBFCs are repossessing or banks are not repossessing vehicles. So this availability of vehicle is an issue, but definitely we see demand even from the pre-owned vehicle side. So from a growth perspective, and then tractors, of course, are doing pretty well. Put these 3-4 things together, I think that's going to be the clear growth driver as far as going forward is concerned. But nevertheless, the AUM growth will be very range bound, because if the first 6 months of the year is anyway lost, however you may do well in the next 6 months, it can't cover up for the whole year. But I would rather look at post 21, if things were to open up and we were to get back to some kind of a growth over 20-25%, if market opens up, that's a time we would like to measure our real AUM growth. At this stage, we would still have around 8-10%. You saw even in this quarter, the growth is about 12%. So I think that kind of a range is what one can see.
Okay, fair enough. Now, tractors, passenger vehicles, LCVs are all seeing healthy demand, but it's HCVs that are continuing to lag. How do you expect your product mix to be skewed towards tractors and passenger vehicles?
So if you look at our balance sheet, we were anyway not a very significant CV player. While, in our CV segment of 12-15% that we have, that includes even LCV pickups and all those kind of stuff. So if you were to just look at heavy commercial vehicle, we would be not more than 3-4%. So it hurts us the least if that segment was not to, immediately improve and will take a little more time. So our bias has always been towards tractors, pre-owned vehicle, passenger cars, auto sector, small vehicles like pickups, etc. And if those segments are doing well, we should get the benefit. Yes, CV is definitely was one of our growth driver because we had almost no lending to CV business. And when we got into that, it became an addition directly. So to that extent, yes, compared to previous year, we would have no growth in that segment. But that shouldn't be a dampener in as far as the overall growth is concerned.
Can you talk to us about the credit cost guidance for FY21? Borrowing costs have eased. There seems to be ample liquidity. Is there a case for margin expansion?
So surely, there is no pressure on the lending rates so far as market is concerned. So the yields would hold up. What we have benefited from, as you said, is from the borrowing cost. But unfortunately, because of the liquidity pressure that all of us forecasted in April, all of us are sitting on large sums of funds as a buffer, and therefore there is this carrying cost, which is a part of the borrowing interest cost, and that's why you see some compression on the margin. But as we adjust ourselves from the overall liquidity holding, so we also will think we are now currently holding close to about 7,000-8,000 crore, but we may bring it down to an extent, and if that was to happen, you would see expansion to the margin surely happen. So I think we would definitely believe that given where the borrowing cost is, and given our own ratings and the overall size and our ability to raise funds from multi-source, etc., we would definitely believe that there is a scope for a slight improvement to the margin. I think the other element of the profitability will come from our focus on cost. If you look at our overall cost, it has also substantially come down. Of course, there are two elements to that. One, because of the overall volume being low, definitely the variable cost would have come down. But even otherwise, there are some fundamental actions that we have taken where we have been able to curtail cost. So that will continue to be sustained, and that would improve margins. Finally, on the credit side, credit cost, as I said, we are very buoyant to believe that the next 6 months for rural, that is October, March, normally is a very good period. And we do see signals of that from good monsoons. We see spending on the infra fund, and therefore the customer sentiments and ability to repay will definitely go up, barring one or two segments that I talked of. So I think even the credit cost is expected to remain under control. So we will believe overall for us it could be a correction story.
Lastly, sir, give us an update on the performance of housing finance subsidiary. There has been growing demand in the affordable housing segment. What are the trends that you're observing?
So one thing I would like to clear is, our housing business is again focusing in rural market. We are financing in the villages people who are, room addition, room expansion, room improvement. And about 15-20% of the book comes from low cost housing or affordable housing. And we do see demand for that. But, as you know, in the rural market, this is not their priority, right? When their cash flows are under pressure, they like to first set aside for their personal needs before they can get into, house improvement, etc., which they look at it little more on the aspirational side. So they delay that. Surely we do see that will start to improve as the cash flows in the market starts to improve there. There again, the pressure was really, the rural cash flows when it went through some difficult times, there was a pressure built up on the overall collection and the NPA, which we have started seeing correcting. So I think rural housing for us is a growth engine. And if you look at the next 2 or 3 years for that business, you will see aggressive growth of book as well as asset quality correction leading to good improvement in profits and returns.
Thanks so much, sir, for taking out time for us. All the best for the future. On that note, we are taking a break. Coming back quickly, stay tuned. The management at Rossari Biotech will be joining us. It's a new listing that we are talking about. They have declared their, first set of numbers after listing. We'll talk to the management.